Are you ready, Dan?
You betcha.
All right. Welcome, guests and fellow presenters. I want to thank you all for joining us tonight for our final quarterly Canadian Real Estate Mastermind Passive Income for 2020. I want to thank all the presenters that are pouring into us with their knowledge and energy today. And again, the vision and goal of these meetings is to demystify the world of passive investment and to help as many people as we can to participate in investment properties and passive investments in general. We want you to walk away today with a few great ideas for you to act on or hopefully research on and then follow up with. We understand that 2020 has been a strange year, and what it has shown us again and again is that passive investments, be it equities or real estate, continue to be one of the best generators of wealth in the country and in the world. And when it comes to real estate, we love to say that the best investment on earth is earth. As a pleasant reminder, please mute yourself unless you're presenting, and use the chat bar to put forward any questions that you have. If you don't get a chance to have your question answered, I am recording this. I will send this out to all the participants with everyone who has presented their contact information. So you'll be able to get hold of anyone who is speaking today. The concept and the ground rules of this meeting started earlier this year when we had a number of different investors mastermind, and we thought, why don't we get together and share one idea each on a passive investment opportunity? So each presenter has 9 minutes. I'm going to take a little bit time from each of them in the beginning. I'll introduce them. Then the presenter has 6-7 minutes to present their idea. And at the end, there's a minute available for questions, or sometimes the investor uses up, the presenter uses up the whole time. So that is, in a nutshell, the concept. Our first presenter has been with us since the very beginning. Mr. Dan Wertel is a fantastic Vancouver real estate agent that specializes in investors and other properties as well. He's an accredited real estate investment advisor with over 9 years as membership in the REIN group, and runs a very successful real estate investment Facebook page called Vancouver Real Estate Investors, and hosts a successful investor podcast. Dan, welcome.
Thank you so much. That was a very great introduction. Really appreciate it, Roland. All right, are we doing a screen share, or how do we jump into
you talk and I'll drive.
Okay, great. Well, yeah, Roland, I have nothing to add to that as far as an introduction. So let's just jump right into the presentation here. And yeah, thank you everyone for joining us.
Can you see the slide?
I cannot.
Can everyone else see it?
I can see your slide. They're just a little cut off on the left side, Roland.
Okay, I see it.
You see it? Wonderful.
Yeah. Okay. Let's jump into this. So the area I'm talking about today is Parksville, BC. So for those of you who may not be super familiar with this, it is on Vancouver Island. It is about a 30-minute drive north of Nanaimo. Population there about 12,500. The economic drivers for Parksville are the service industry, construction, and business and financial. As many of you have probably heard, there's been a lot of activity and a lot of attention on Vancouver Island last couple years. And so much so that a lot of people are being either priced out of or looking to sort of the auxiliary cities, you know, outside of Nanaimo, outside of Victoria. So Parksville is the closest city outside of Nanaimo. Recent stats, detached home sales, they're up 158% from last year. We've seen an average price jump of 9% over the last 12 months. And if you can believe this, there's less than 1 month of inventory left in Parksville right now. That means if no new homes came on for sale, Parksville would be completely sold out before Christmas. And on the rental side, it's sitting at under a 1% vacancy rate. Next slide, please.
1 second. Oh, there we go.
Okay, so the property we're looking at today is 4033 Allview Lane. This is a brand new 3-bed, 3-bath plus a legal 1-bed, 1-bath suite. All in, the home's about 3,200 square feet, and it sits on a half-acre parcel. There are some partial ocean views as well. It comes with a 4-car garage, which can also be utilized as a workshop, which I'll get into in a sec here. And there's also RV parking. So there is some potential for revenue from either parking an RV on there, maybe a boat with a trailer, that type of thing. There are 11 lots in a BRRRR strata, and they pitch in $25 each, and that maintains the common septic. This property can be picked up for about $825,000 GST inclusive of that. Looking at the income now, the main home would get $2,000 per month. The 1-bedroom legal suite, you would achieve $1,300 per month, and the RV parking in and around $150 per month. So that gives you a gross monthly income of about $3,450. To operate this investment, monthly costs are insurance of about $150, property tax $190, and yes, it's a brand new home and it will come with that 2510 warranty, but let's put in a 2% repairs and maintenance budget to start putting money aside for that now, about $70 per month. As mentioned earlier, this does have that BRRRR strata fee of about $25. Utilities, I budgeted $100 per month, but of course this could be negotiated with your tenants. And vacancy rate, again, it's sitting under 1%, but I like to play on the side of caution and I've built in a 3% vacancy rate here, leaving a total monthly operating cost of $635 per month. So your cash flow, we realize we have $3,450 in gross rents, expenses at $635. A mortgage on this property, budgeted 1.89% or estimated that with a 30-year AM. That puts you at $2,400 per month. So all in, you are then left with about $414 per month positive cash flow. To purchase this, minimum 20% down payment of $165,000, transfer tax at $14,000, an inspection of around $600, your legal costs at $1,500, and it's always a good idea, of course, to have a bit of reserve fund, so $10,000 set aside for that. That means to add this property to your portfolio, you'd be looking at an initial investment of about $192,000. So question is, what does that give you? Well, this is obviously a bit of a safer, sort of a lower risk kind of turnkey investment and such. The cap rate's going to be lower. So an as-is tenanted property, this gives you a cap rate of around 4.1, cash on cash about 2.6%. So to simply hold this property and sell it after 10 years, again, as a 10-year-old property, I think this will still be very attractive to a lot of people. I've targeted a 3% appreciation rate. Yes, it got 9% last year, but I don't think that's going to sustain. So 2019, for example, was 3%. So if this home were to average 3% appreciation rate, it would have a market value and sale price of around $1.1 million. After your sales costs, this would turn a profit of about $492,000. That's a total ROI of 257% or 25% annualized. Quick little analysis on this one. On the strength side, again, brand new property, you're covered by the warranty, it should be low maintenance. It does have the multiple revenue streams. It is in a city that is targeted as to grow and has good economic fundamentals. It is a cash flow positive property today. On the weakness side, yeah, it's a small city, right? There's only about 12,000 to 13,000 people there. That does have inherent risks. And it is out of the GVRD, right? This is not a property you can drive 15, 20 minutes and go check up on it. I have budgeted this or created this pro forma with it being self-managed, right? Because of course, if you go and add in the 10% property management that it costs over there, you're eating largely into your cash flow. So this is one that you would have to plan to probably go and visit, every 3 to 6 months. On the opportunity side, I think a large tenant profile, right? The people that are attracted to the Parksville area are retirees, young professionals, and I think both sides would really enjoy this property. Sitting on that half acre, I do believe there to be potential future subdivision opportunities there. This property is on RS2 zoned land, so you can actually build multifamily on this in the future. Oh, I also want to touch on this too. A client of mine who owns a property in Nanaimo, it had a 2-car garage attached to it, and he just converted it to kind of a suite. Now, this is not obviously with a full kitchen as there's no venting, but he's got a hot plate in it. It's 220 square feet. And if you can believe this, he's renting it out for $1,050 per month. And that's Nanaimo. So again, maybe you take 2 of the 4-car garage spots, convert that to a suite, or even convert it to a workshop. I think there's potential for further cash flow there. On the threat side, tourism is largely driven in Parksville. So, we don't know when tourism is coming back. And of course, let's say Nanaimo starts to rezone and densify and make housing a little bit more affordable. That may attract people to stay closer to the bigger cities as opposed to looking for outlying areas to live in. That is basically my presentation. Thanks so much for listening. If you'd like to learn any more about myself or the type of properties that I offer clients, please have a look at thevancouverlife.com. Thanks again.
You, Dan. Thank you very much. Our next presenter is Calvin. Calvin Hexter is a realtor specializing in investment properties from Edmonton. He brings a fresh energy to the real estate space, providing modern day experience with old school principles. He has experience in the past 10 plus years, over a decade, with over 100 happy clients. He again specializes with investment properties in the investment real estate space throughout Edmonton and the surrounding area. And he has a focus on cash flow properties, fix and flips, and creative real estate. Calvin, can you hear me?
I can. Thanks for the great introduction, Roland. And you know what I'll probably do is, like, first slide, I'll just like point at you every single time you want to switch to the next one. Looking back, I should have probably had a cool background like Daniel Yu, but I just got my tight little condo here instead. So thanks for having me. This is my first like 7-minute presentation ever. So thanks for bearing with me. Welcome, guys. So happy to be a part of this tonight. I'm talking about Edmonton and why people are looking at Edmonton as an investment. So why Edmonton? Why am I working with clients from Vancouver, Toronto, outside of Edmonton? Many different reasons. One of the biggest reasons are purchase price. Our purchase prices are very affordable. And I think right now more than ever, if we do go into this COVID 2.0 and we don't want to put all of our eggs in one basket in a market that does cost considerable amounts of money to get into, Edmonton's a great choice. Edmonton's also very much known for its, or I guess Alberta in general, for its more relaxed landlord rules. We don't have any land transfer tax, no PST. We don't have a limit on how much we can increase rent on an annual basis. So if you guys want to increase it by 10, 20% after 365 days, boom, you guys go ahead and do so. So there's that option. Other reasons why is the market in Edmonton has been flat for the last 10 years. So I have to say that Edmontonians have grit. We have resilience. We haven't been seeing the crazy appreciation that we've been seeing in other cities. But what we have been seeing is great cash flow numbers. Our city isn't so weighted on just oil and gas. We're quite balanced with like government jobs as well as manufacturing plants. So, unlike cities like Calgary, if oil does take a big hit, we're not usually crushed because of it. Okay. Now, what I wanted to do is I wanted to show you guys just a general kind of rule of thumb of what we typically see for cash flow. Now, the first one you guys see here, if you guys want to direct yourself to the screen, is condo apartments. What's an average purchase price? Well, it's way over $100,000, but I'm showing you what an average purchase price would be to achieve cash flow like that. Now, we just had a high-rise built, I think, last year, and there's condos in there going for like $3-4 million. Those are not going to cash flow. But what is going to cash flow are these properties right here. So I'm showing you guys basic estimated purchase prices and what you can kind of see. So I'm going to walk through them with you guys. Now, condo apartments, great for Airbnb, short-term rental, not ideal for long-term rental. You get hit with a special assessment, boom, your cash flow's gone for 5 years. Townhouse, we don't see as many special assessments, cash flow slightly better. Purchase price is still pretty attractive, but I think we can do better. Now, bylaw 12800 passed in September of 2019, allowing us to suite duplexes, including half duplexes. So we can get into a half duplex. And for those of you guys that are listening right now that don't know what a duplex is, it's a side-by-side building separated by a party wall, whether it's a side-by-side, front, back. But you can get a half duplex for about $340,000 turnkey and see about $450 to $600 in cash flow. And kind of like Dan alluded to, if you're going brand new, your cash flow is probably going to be less, but you're also going to have more of a maintenance. You're going to be able to defer that maintenance for longer because you have that turnkey asset, which is super, advantageous for a lot of us, especially if you don't want to have to deal with that. The two most popular investments that I tend to work with are single-family detached suited houses, whether they're conforming or non-conforming or non-legal, which we typically see 90% of them being present in the market, are going to be cheaper and you're going to see bigger cash flow. But the legal ones are going to give you more security at the end of the day, knowing that the city's not going to come knocking on your door saying, hey, you need to legalize this. You need to add a second furnace, add whatever you need to make it legalized. So if you like the legalization side of things, these are the numbers you can kind of expect. Single family detached, you're looking at about $450 to $800 a month in cash flow, and you're looking at about a $400,000 purchase price. This goes on average. Now, just like in like areas like Vancouver, because I feel like there's a lot of people right from like Vancouver in this presentation. If you're buying closer to the university or hubs that are highly attractive, yeah, you're going to be paying a lot more and your cash flow might be less. Your vacancy is going to be better, maybe a better tenant profile, more of a selection, and potential for greater appreciation. These are just the averages, okay? The most popular return on investment for cash on cash in your pocket, which you usually see about a yield of about 12% plus, is suited duplexes. So if you have a duplex and you add a secondary suite, we're seeing about $1,200 to $1,800 in cash flow. Purchase price around $650 average. You buy near the University of Alberta, which is a very popular hub with vacancies less than probably 2%. You're probably paying closer to $900 to $1 million. So the nice thing about these options is that if COVID 2.0 does hit, and I know a lot of us are looking at using things like equity, pull that out and use it as a down payment for a purchase, you don't have to spend all of your money to get into a great investment that's going to provide you cash flow. And the best thing about these investments is that if we ever do see a rental contraction in the market, which we do see, like every market does see, and we know that vacancy rates go up and you need to drop rents, you're still cash flowing. Because if you're barely seeing cash flow right now, what if we do hit hard with this COVID 2.0? What if we do see a rental contraction? That cash flow goes to zip, and now all of a sudden you're paying out of pocket and you're banking on that appreciation that may or may not come if that infrastructure does come or that demand for population. So just a basic rundown. You guys can screenshot the hell out of that screen if you guys want, whatever you'd like. But those are kind of the averages that we see. Let's go to the next one. Okay, so let's go through BRRRR. Who doesn't love BRRRR? BRRRR is one of my favorite strategies for creating momentum in real estate. Why? Because our goal is to put money in, make that property better, force the equity up, and then try and pull as much of that equity out as possible, and let's rinse and repeat that same cycle again. So I'm giving you guys an example, and I wanted to pull it from one of my favorite clients in Vancouver that purchased this property last year, and he just purchased another one from me 2 months ago. So sold price, he bought a full duplex in Delton, which I'd consider probably like a B plus style community neighborhood, for $420,000. His down payment was $84,000. So this property had more or less a retro main floor, but it was rentable. I think he's getting about $1,450, not including utilities for the main floor. His goal was to add 2 secondary suites in the duplex, converting it into a 4-unit cash flow property. Now, once he completed that, the renovation cost was about $130,000. That's including things like holding costs. He didn't have to borrow the money, so we're not having to equate to, the crazy interest rates you're seeing from borrowing. He's more or less just paying for the mortgage, utilities, and then had the money to be able to renovate. The new value just got appraised. It actually got appraised at $625,000. So he was able to generate quite a bit of equity from adding this value to this property. Now you're probably asking me, well, Calvin, you're all the way in Edmonton. I'm not gonna frickin' do renovations when I'm like 10,000 miles away. Well, you know what? Roland, next slide. That's why you need a team. Anybody that's in real estate investing, which I think everybody here is, or if you're just starting out, my biggest tip to you when you're starting out is get a strong support system. Get a team that cares about you and what your goals are and listens to what you want, because that is the most important thing. So if you're looking at investing in Edmonton, we do have lawyers, accountants, handymen, general contractors that I'm going to recommend to you, and I'll give you a long list of them that have a credible background that can help support you in these projects. Okay? You probably end up hiring a general contractor as opposed to doing it yourself, but at the end of the day, the profit you're making, whether you're going with a turnkey asset and seeing great cash flow and tenanting it day one or doing a burst strategy, either way you're winning. So I wanted to make sure that we do have the support for you if you do look at investing from abroad, like a lot of people do. So you're not stuck in your market at any point. There's always options and opportunities. And I'm always here to have that conversation. So I like to bring lots of energy and fun to it. I have your best interest at heart. And you know what, that's why I continue to work with some great clients. And it's just a growing list. So thank you guys very much for having me. Roland, I hope I was under 7 minutes. I was probably over. My apologies to the next presenter.
You'll be forgiven the one time, Calvin. Thank you very much. Our next presenter is OWEN BIGLAND. OWEN has been an investor since the wee age of 18 when he purchased his first stock, Pepsi, a stock that he still owns today and he has added to many, many times over the years. OWEN has also been a longtime real estate investor by buying his first investment property over 30 years ago, and that was a 1-bedroom condo in Richmond, which he still owns today. He would classify himself as a buy and hold investor, buying mostly blue chip dividend paying equities that also have a very long-term track record of dividend increases. He likes to focus on what his stock and real estate portfolios are producing in the way of passive income, opposed to being focused solely on price and the day-to-day valuations and fluctuations. Owen is also a published author. The book is called Along for the Ride. It's a great book on passive income. I have a dozen of these books, so if anyone wants them, contact me and I can mail one out to you. Again, it does a great job talking about passive investment and in both real estate and equities. Owen, are you there?
Turn my microphone on. I'm here. Can you hear me?
Yes.
Great. Thanks very much for the introduction, Roland. Thanks again for putting on this evening. Really enjoyed the first two presenters. That's the thing I love about these type of things. We're going to get all kinds of different ideas, real estate, passive income, stock market, all that good stuff. So I'm always interested in hearing other people's perspectives and learning some new things tonight for sure. So what I'm coming at, even though I'm a realtor here in Vancouver and I work with a lot of investor clients and I've built up a pretty good size real estate portfolio over the years, I'm going to come at you something tonight a little bit vanilla, but bear with me on this. I think this ETF, which is XEI, which is the TSX High Dividend Index ETF, it's kind of vanilla, but it's something that I think everyone should have in their portfolio. I call this kind of a foundation holding for me. If you could turn the slide, Roland. So XEI is a low-cost ETF put out by iShares. It holds anywhere between 50 to 75 stocks. No stock has more than a 5% weight, and no sector has more than a 30% weighting. So if you look at the holdings in this ETF, well, actually, sorry, I'll give you my disclosure here first. I've been buying this for many years, but I was buying quite a bit of it back in the big pullback we had here in March, April, and May, picking it up at around $13 and a half, $15 a share. I've been buying more of it at 17. It's currently, as of November 2nd, yielding about 6.38%. That's the current dividend. I hold this in all my cash accounts. Most of my TFSA and RSP is in US equities. That's another show for now. If you turn the slide, Roland, half of this portfolio is basically held in 10 companies. And the companies it's being held in are all blue chip names. We're talking Royal Bank, TD, Bank of Commerce, Enbridge, Suncor. It's really the best of the best of Canadian, big blue chip Canadian companies. And the strengths for that is you're getting security in numbers. One click and you're holding 20 of the best Canadian dividend payers out there, currently yielding you 6.4%. The dividends, if you look at the PE ratios on these holdings, because many of these companies I own individually, like the banks and the Bell Canadas and the TELUS, these are trading at pretty reasonable PE levels. The dividends payout ratios are quite low on a lot of these holdings. So that 6.3, 6.4% yield is pretty solid. There could be some dividend cuts or some freezes, but overall, this is going to continue to give you a pretty solid yield year after year on this holding. And I think at the current valuations at about $17, $18 a share, there's some pretty good upside here. So the strengths on this is they're strengthened in numbers. You're getting 50, 60 companies, the best of the best, yielding you 6.3%. The dividend on this is paid monthly, not quarterly. So every month you're going to get a dividend payment on this. The management expense ratio is very low on this, 22 basis points, which is very low, less than 1/4%. And the current PE of the entire fund is at about 14.5. So again, fairly low PE. I think there's some good potential for capital gain over time on this at the current value. But the dividend on this, 6.4%, 6.3%, is going to do all the heavy lifting for you here. So you hold this, I think, for the next 5 to 10 years, even with a very modest 2 to 3% capital gain every year, you're now talking 10% annualized return on this. That's pretty tough to beat. And that's why I recommend this should be kind of a core position or a core holding for most people, no matter what your age or your current portfolio, your net worth or whatever. Now, weaknesses, 28% of this fund are held in oil and gas. But the oil and gas plays in this are companies like Suncor, Imperial Oil, Enbridge, TransCanada Pipeline. Now, those stocks are pretty beaten down. That can be a benefit as well. Some of these are trading at pretty low PEs, and I think the dividends are fairly safe on these. Other weaknesses, Canadian economy, probably going to underperform the S&P 500. We're probably going to be in a recession here for the next few years. And of course, there's still a lot of uncertainty around COVID and what that's going to have on impact on the economy and jobs. But I do think if you look at the underlying holdings in this, as I say, TD, Royal Bank, Bell Canada, TELUS, Enbridge, Bank of Nova Scotia, Canadian Manulife, Sun Life, Algonquin Power, Brookfield Asset Management, Finning, Hydro One, Chartwell Retirement REIT. Basically, you're getting a lot of diversification at a low cost and a high yield here. Pretty safe. 30% in financials, 28% in energy, 14% in utilities, 12% in communication services, about 8% in real estate. So if you look at the individual holdings here, the PEs on the TD and the Bank of Nova Scotia and RBC are very low. Real estate makes up about 8%. Those are trading at multi-year lows. Bell Canada, TELUS have a long commitment of keeping and growing their dividend. Suncor, I think, could see some good price appreciation. I think the pipelines are more toll carriers more than anything. Dividends are fairly safe with those. I expect COVID will end, and I could see some good appreciation in this fund going forward. As a matter of fact, I sent this to you, Roland, early last week. XEI is up about 9% here in the last week, but it's still well below its lows. So again, I think when you can get a 6.2, 6.3% dividend, that's pretty safe. Add in, another 2 or 3% on top of that, very conservatively going forward as far as capital gain. Now you're cooking with 10%. Final thing I'll leave you with here is the nice thing with a form like this is that, we're going to see lots of different ideas. And, there's never one size. It was tough for me just to come up with one selection here. I want to just at the end here, just talk about a minute about real estate as well, because that's my main investment area. But, there's no one size fits all for investors. And what might be suitable for one person might not be for another. If you take a company like NVIDIA, that might be a fantastic stock for a 20-year-old in his TFSA, but might not be too good for a 70-year-old retiree because the stock is up 400% and it could get cut in half here. So not good for everybody. XEI, on the other hand, I think is suitable and is one of those core holdings that most people should have. And a couple other ways this might come in. I have always kept an emergency fund. Most financial advisors will tell you to keep, 3 to 6 months salary in a bank account or a fixed income of some sort. Lately I've moved pretty much all my emergency fund into something like XEI here that's going to pay me, 30-fold what a bank account is. 3 years ago on a high interest account, I was getting 1.25%. Today I'm getting, last I looked, 10 basis points. It's just too pitiful for me to put cash in there anymore. So a holding like XEI could be quite good and I think quite safe as an emergency, as a cash fund, where you're going to get some capital gain and you're going to earn a 6.3% dividend. The other area where I'm starting to use this, I get a lot of clients who will ask me, they're saving for the down payment on a house, principal residence, or an investment unit. They're going to need 20% down. I've always told them to just put that in a bank account or a term deposit. But depending on the time frame, if someone comes to me now and says, I'm looking to buy a house, it's a 3 to 5 year time frame, I'm starting to tell them they may want to look at putting maybe half of every dollar into something like XEI, only because bank accounts are just paying such a pittance these days at 10 basis points if you're lucky. Something like this could be suitable for saving for the down payment, provided you've maybe got a 3 to 5 year window there to save. If you're ready to buy in 6 months, I would just keep it in a cash account. Final thing I'll leave you with, if I've got one more minute here, Roland, if that's okay.
Yeah, you're good.
Okay, I'll just talk quickly about real estate here. Just wanted to, because it's so tough to just pick one investment, and I really, last time we were able to do one real estate and one stock. An area that I'm keeping an eye on now in Vancouver is, as you guys know, I'm mostly focused on downtown Vancouver, east side, west side. An area that I'm starting to keep an eye on this winter would be small studio or studio apartments, junior 1 bedrooms, some without parking in grade A buildings. Now, there's some pretty good opportunity they're starting to surface right now that I've been keeping an eye on some good grade A stratas downtown. And these would be studios, large studios, 560 square feet, no parking, in grade A buildings in areas like the West End. High-end buildings, concierge, air conditioning. We're talking buildings that have $3, $4, $5 million units in these towers. You're getting a loss leader in the $550K range. And these are off about $40,000 from where they were a couple years ago. This area has been very hard hit with COVID, these smaller studios and junior 1 beds, because they were students that were renting these. They were corporate rentals for a year or two. Some of them were short-term furnished rentals. COVID has really put a big damper on that market, and a little tougher to get tenants in those right now. Prices have been coming down and inventory has been going up. Pretty good area to keep an eye on this winter, because there's some units now that you can purchase for under $1,000 a square foot. These were renting at $21,000-$21,500 a year ago. A little bit of choppy waters here until COVID is over, but it'll end. The borders will open up. The quarantine will end. Students will start coming back in. Corporate rentals will start kicking back in. So for a long-term buy and hold, if you can buy one of these at $1,000 a square foot today in a grade A building, and that's the key here too. Don't just buy anything. There's a lot of dogs out there. These are grade A buildings that are well off their highs. These could be easily renting back up at $2,200 a month in another 18 months from now. So pretty good area to keep an eye on in these studios and junior 1 beds for downtown right now. That's it. Hope I didn't go over time. Thanks for having me today.
We have more graces today with time, as there's 2 presenters that couldn't make it today. So I've let everyone go over. I think you were like 14 minutes, buddy, by the way.
Oh, sorry.
Thank you very much. Our next presenter is Mr. Daniel Yu. Daniel was fortunate enough to start his real estate career immediately after university. He started out with the residential sector, but had always had a big passion for investment real estate. Daniel was fortunate enough to learn from local developers by helping them acquire and sell multifamily land assembly developments throughout the Canby corridor craze. He was gaining an analytical insight from their medium to large scale operations. He had the pleasure to be involved with investment companies in repositioning rental apartment buildings and mixed-use buildings. Daniel now spends significant amounts of time in the industrial real estate space, assisting small businesses to end their tenant life and start owning their own industrial workspace, acquire industrial development sites for developers, or creating strata warehousing solutions. Welcome, Daniel.
Hi, thank you. Thank you everybody for coming here tonight. Great ideas so far. I only have 3 people done their presentation, and I already got lots of ideas in my head. So today I want to present to you guys a very unique property. So my partner David and I, we have just put this particular listing on the market. This is an apartment, it's a multifamily complex located in West End in downtown Vancouver. And it's comprised of 6 stratified units, and they're all townhouses, and they all have 3 levels each. So this location is located on Harrell Street in Cardero, and it's around 1 block away from the big Safeway off at the end of Robson Street and Denman. So the location for this multifamily complex is it's amazing. Tenants love to be in this area, and they like how it is close to all the amenities on Robson Street there. And go on to the next slide. So this property, it's mostly comprised of 2 bedrooms, and it's got 5 of the units are 2 bedrooms, and 1 of the units 3 bedroom. And this complex is also made up of 6 individual owners. So if you guys are not familiar, in recent years, there's been condos and small complexes coming together to decide as a strata that they would like to sell together. So this is one of that scenario. The 6 individual owners of this complex came together, had their strata meeting, and they decided to come together and agree to sell together. And we're listing it on behalf of a strata council. Most of these units are over all the units are over 1,000 square feet. One of them is actually a 3 bedroom. And the land size of this is around 4,300 square feet. So this is more of a multifamily holding property and investment play, and not a development play. What's unique about this kind of opportunity is that you will be acquiring this complex as a stratified building, which gives you lots of flexibility. So what we're seeing other investors do in this kind of scenario is that they will keep it stratified instead of liquidating the strata plan, as what many developers do. Keep it stratified. They would renovate and reposition these apartment units or townhouse units, and then they could hold it and continue to rent them out as a rental multifamily investment, or they could decide to sell all of the units and put on open market and sell it as renovated and renovated apartment townhouse units. Many of them will choose to keep a couple units and then rent out a few. Some of them leave it for their family members to live in. So because these units are occupied by the owners themselves, so we do not actually have a financial statement to work with like we do for many rental complexes. So we went around and then we did some research on nearby rental rates, and then we found out that units of this size in the neighborhood, we could get around $3,000 per unit. Because this is more unique, it comes with 1 parking, and some of them have rooftop decks, some of them are renovated. We bump up the rental rates, the estimated rental rates up to some $3,200, some are $3,500. The other thing to note there is that this building, half of the units have actually been renovated, and the renovations are not done by investors. They're all done by owner occupiers who have their families living there themselves. So these are done up to the standard. And what's great about this aspect about this investment is that a lot of the multifamily investors, they sometimes like to see some of the units being done already so they can work on the rest while they have some of the units maximizing their rental potential. We've also discussed with some property managers that we know, and we found out from them that the expense ratio for downtown area multifamily complex sits around 35 to 40% expense ratio. So we kind of use that number to come up with this projection that the total expense throughout the year should be around 37%, providing us with a 2.6% cap on this complex. If you guys want to go on to the next slide. So this is just like a couple of photos that we have of the property. The rooftop deck is amazing. We've actually seen one of the units there already, and it's just a great place to be with. One of the bigger selling point about this complex is that majority of the rental units that are available in that neighborhood, they don't have these larger size units. They're more catered for a single person or for a couple to live in, where these 1,000 square feet townhouse units could fit a family in there. And having a rooftop deck in West End, it's definitely a plus. We can go on to the next slide to see some of the photos. As you can see, lots of these renovations. This building was built in 1985, and a lot of them have been updated throughout the years. 3 units have been majorly updated. So it's a great plus, and it saves the investor quite a bit of money. Going back to the next one. Yeah, just some photos. Another thing I would like to add to this investment is that sometimes when we have a situation like this kind of listing, a lot of the owner occupiers, they would like to stay. They would like to stay in the unit after the deal have closed. So immediately you would have a tenant that's already living there. Don't have to worry about moving in and out. And since they've been living there for a longer period of time and they used to own the place, they would take care of the property much better as well, compared to a normal tenant that we find off the internet. So this will help maintain the complex in a much better way. And then also, one more thing to add is that this complex also comes with 6 underground parking that's assigned 1 unit to each strata lot. That's pretty much it for this this investment opportunity. We've gone to the next slide. We have the SWOT analysis. So this building being stratified provides the investor with lots of flexibility. They can, for example, I understand that there's lots of buildings in the greater Vancouver area that don't allow a Airbnb operation. They're not allowed to rent out their units for an Airbnb. So if a potential buyer were to buy this investment, they would have 100% share of the strata votes, and they could propose to themselves that they want Airbnb to be allowed, and no one will go against them because there's no one else. So that's convenient. Other than that, like I mentioned before, we've seen it in the past where investors, they just renovate the whole thing. Maybe a year down the road, they would hire a realtor to put all 6 units on a market together and sell it as a project marketing. And they could do that as well. Or they could keep a couple of units, and when one of their kids needed some cash, they could sell off 1 unit or 2 unit to help their kids out, and then keep the rest of it as a rental investment. The weakness about this investment is obviously with many apartment buildings. These are all built years ago, and there's structural issues, maybe potential roofing that they got to be replaced, and it's much more expensive than a residential house. There's potential water ingress problem, potential rain screen problems that might pop up in the future. The other issue about this specific investment is that the land itself is just over 4,300 square feet. So you're going to be looking at this as a multifamily rental investment and not as a development play. As always, being a landlord, there's always going to be issues with tenants. Can't get away from that. The opportunity part, it's just really rare. It's a really rare opportunity to find this kind of product on a market. Majority of the apartment rental, multifamily rental investments that we see in the West End market are between 20 to 30 units, and those will fetch far above $10 million each building. So if there's an investor out there who's looking for something that's less than $10 million, but they want a AAA location, this will be a great option for them. The other thing is that this is a smaller building complex of 6 units. A lot of times I hear other multifamily investors, other Zoom meetings and other discussions out there saying that 6 unit is kind of like the benchmark between getting a property manager to look after the complex for you or to self-manage. So this is kind of like the maximum number of units that we go for self-management, and that could help them save on some of the expenses. One of the threats is that there is an underground parking in this complex. So over the years, issues may come up that they got to spend some money to maintain it well. And obviously renovation costs, material costs are on the rise. So that's one of the issues that we're seeing as well. And that could become a potential threat. So this is a great opportunity for somebody who wants to look into the multifamily market. It's something that personally I haven't seen before. An opportunity like this, sub 10 units at a AAA location in downtown West End. For this particular listing, we we just got. We are having a tour of this property tomorrow from 1 to 2 o'clock. So if anybody's interested in taking a look at this one or want more information on it, shoot me a message, give me a call, and then we can chat more about it. I typically don't talk about my active listings, but I just find that this is a very unique one, and we don't often see this kind of stuff on the market. So I like to bring this one to the meeting and share with everybody what's potentially out there. That's pretty much it.
Thanks, Daniel. And again, we are recording this, so I'll share it with all the attendees, and I'll include all the presenters' contact information so you can get hold of Daniel and everyone else. And if for some reason you're struggling, just contact me and I'll make the connection. One of the presenters that is unable to present today, as she is in transit between Vancouver and somewhere else, she's very excited, however, to be at the January Q1 version of this meeting, is Melanie Robinson. I'll just read out her substantial background, and so you can have an idea of what she will offer us in January. Melanie is an avid real estate investor who's committed to making a difference in people's lives through investing in real estate with over 20 years of experience in coaching and consulting. She has a diverse background in real estate investing, flipping, and the BRRRR strategy, as well as new builds, foreclosures, and long-term hold and buys. Currently, she's focusing her attention in 2 areas, one being raising capitals for projects such as a fourplex she's currently building on Vancouver Island, and her many flipping projects she has done over the years. Melanie's very entrenched and has a great reputation in the real estate investment community. She does a weekly live program on fearless real estate investors called Mind Power Monday with Melanie. And she has lots of accountability calls with fellow investors, helping with their mindset coaching and helping them move forward from being an observer into an active participant. And she's also a member of the RAIN Real Estate Network. So I think she has an amazing background. We're really sad we couldn't hear from her today, but that gives you an introduction to one of the presenters that will be there in January. The presenter that is here for us, I'm really excited to introduce, is Adele. Adele's real estate journey began at the age of 23 years old when she purchased her first triplex and quickly learned that it is possible to have a roof over one's head for free, or nearly for very little out-of-pocket expense. That triplex was also her first real estate mistake when she sold it. Years later, Adele purchased a duplex. This time, when she moved out of it and into a single-family home, she did not sell it. That duplex has been refinanced more than once and has allowed her to expand her portfolio. To date, she has 57 doors. That is amazing. And in 3 provinces with 11 land development deals in Canada and the US. Real estate is Adele's passion, and she truly believes that building generational wealth through real estate investing is attainable for anyone by partnering with the right people. Welcome, Adele.
Thank you. Thank you for having me this evening. I'm excited. My first time here. So yes, this is my my little portfolio. Those are my 57 doors. The 2 on the left are in Montreal, where I live. The 2 in the center are actually in New Brunswick, and the 2 on the right are in Ontario. So, and Daniel, your $3,000 rents there just killed me a second ago when you were talking. That's not what these rents in any of these provinces go for. But they cash flow. And you know what the interesting thing is about these different provinces? It's funny because on the Montreal side, you get tons of equity, not so much cash flow. New Brunswick is a lot of cash flow, very little equity. And in Ontario, you have a nice mix of both. So hence why we spread out a little bit. Next slide, please, Roland. And because I didn't have a deal to present this evening, sadly, I chose to present this one, which we just closed. It was actually my partner, Jessica, and I, who make up REI Visioning. We wholesale this one. It is in New Brunswick, and it was a purposely built, it's a 9-plex, a 9-unit. And the gentleman that purchased it was very, very lucky. He's retired, and he gave us very specific specs, what he was looking for, and took us months, a lot of work, a lot of number crunching, but found this beauty for him. And from day one, the gentleman, super happy. We got it $25,000 under asking price. It appraised $37,000 over the purchase price, and all tenanted, but underperforming by conservatively $400 a unit. So in New Brunswick, no cap rates on rent, unlike some other provinces. So he can go right in there and bring them up to market value. I mean, probably shock to tenants a little bit, but it can be done with the wage strategies. Another thing is the heat is being paid by the owner right now, which is going to be changed over to the tenants. So the location, a great location, 7 minutes from the downtown area, close to major shopping and amenities and university. The units are huge. They're very spacious, separate meters so that the heating can be converted easily over to the tenants, parking in the back, new decks. Other than a little messy, the units were in excellent condition. Very, very low vacancy rates in Moncton. Oh, isn't that funny? Somebody just asked as I said that. Moncton is a city. So again, raising the rents, he's already started. And actually, I think you could change slide now, please. Yes, thank you. Yep, there you go. So at the time of purchase, which was about a month and a half ago, that's what the numbers were there at the top. So right off the bat, the gentleman is making $1,000 a month of cash flow with a nice DCR of 1.48, with the turnover at the speed that you can change over and increase the rents in about a year. His numbers are over 3,000 cash flow. And again, this is conservative. So we had figured the average rent, the units are a nice mix. There are 2 bedrooms, 3 bedrooms, 1 bedroom, 2 and 3. So the average right now is about $755 per unit, and it should be around $1,150. So anywhere from $900 for a 1 bedroom, $950 to $1,300 for a 3 bedroom. So we averaged it out at $1,150, giving him an extra $43,000 in annual income once he increases those rents. And the hydro, which the owner was previously paying, which was about $6,000 a year for the hydro, will also be converted over. And that is the 5-year projection, because equity is a little bit slow there in New Brunswick. So this is he's going to be a zero money in the deal and pulling out about a little over $200,000 of equity and cash flowing well over $2,000 a month. That's a great retirement plan for this gentleman. So he was like so happy. It was so nice to have found this property for him. Next slide, please. And that's it. So we are REI Vision. You can check us out on our website and connect there. We use Calendly if you wish to book an appointment with us. Quebec is a very, very interesting place, and we speak French if you don't. So we could do a lot of the legwork here for you. And we invite people to come to Quebec because often we are the forgotten province, which is unfortunate. Tons of equity here in Montreal and even the outskirts. And a lot of large family, multifamily units. So anybody who's looking for multifamily, Quebec is definitely the place to look for multifamily income properties and get that equity pull out every few years, and tons of optimization opportunities and many different strategies for the BRRRR. And that's it. That's who we are. So look us up. Is that a smiley face? Or
I don't know where that's from. I don't know. Thank you, Adele. That was wonderful. And congratulations.
I sped through that. I was trying to make up for time.
No, you were great. That was awesome. Thank you. I don't know how to get rid of that line. I have no idea where that came from. So I apologize in advance to Chris and Dave. They're our next presenters. I believe Chris will be presenting. Chris and Dave have been business partners for over 3 years, forming a top partnership in the mortgage business for Mortgage Alliance in Vancouver. Their team has grown to a total of 8 mortgage professionals, and I believe it might have even grown since this was written, providing experience and manpower to tackle any financing need across Canada. With over 45 years of combined experience, they provide solution for any financing need, whether residential, commercial, or private lending. Welcome, Chris.
Thank you, Roland, for the introduction. And yeah, that slide is a little out of date, but the experience of 45 years is mainly me. Dave's got 4 years of experience. I've got about 45 myself, I think. So this investment opportunity is a little bit of a combination between, I would say, the stock market investment and buying and selling real estate. So this is an investment into what's called a mortgage investment corporation. What it is a mortgage investment corporation is a private lender. So they take a pool of investors' money and they lend it out on first and second mortgages throughout Canada. So in this case, you're sort of acting as the bank. As you can see from the slides here, you can invest into a mortgage investment corporation as more of a sophisticated or qualified investor. So it's not for everybody, but it does give you a little bit of exposure to certain markets in Canada. So you can choose a MIC, for example, that lands on, sorry, Vancouver Island, or the interior, or Ontario, or Quebec. So there's a little bit of geographic diversification here as well. So from Dave's participation in this group in the last, I guess, last quarter's meeting, we had a lot of clients reach out and they wanted to become private lenders. And the reality is, as an individual, if you're not a mortgage broker or a lawyer, it's very difficult to do. There's a lot of risk that can be incurred by that. For example, you have to go find a borrower, you have to find a lawyer, you have to do up your mortgage documents. What happens if that borrower doesn't pay you back? All your money is kind of tied up in one specific deal. So investing into a MIC allows a diversification of your investment, and you have a professional manager running the show for you. So if we can go to the next slide there, Roland. I just kind of covered off this stuff here, but again, it's like this is a mutual fund type investment. So you're putting your money in with other investors. A lot of these MICs are several $100 million in total asset value. Some of them, you know, smaller ones are 50, some are 100. You can do your research and we can extrapolate some of the different classifications that they have in there for you. Go to the next slide here. Sorry for the small font, but I think Dan at the initial presentation was talking about Vancouver Island. I grew up in Parksville, so I know that market quite well. If you're interested in investing in that market, but you don't want to buy or can't afford to buy your own piece of property there, you can put money into the market in the 460 MIC. 460 is the number of kilometers. So Vancouver Island is 460 kilometers from top to bottom, which is where that name comes from there. So what you can do is you can invest money with these folks. They're great people. They also run 460 Realty, which some of you may know from your ventures over across the ferry there. What they do is they lend money on first and second mortgages. So people that are maybe real estate investors, maybe they need to do a renovation, can't go to the bank, they were turned down for whatever reason. These are the borrowers that the MICs are lending to. So the MIC is the middleman between yourself and the end borrower. Their return, and this is 2019, and I know the year-to-date numbers are quite strong given the market on Vancouver Island is up 100 and something %, but they did just under 8%, and that's a net return last year. So what you're investing into is it's a minimum $5,000 investment. Your income is paid annually, so kind of like a GIC, but at a much more substantial interest rate return. 66% of their business is residential mortgages, so first and seconds. 22% is land, and the rest is some commercial construction. So you're getting a good diversification. Instead, again, of giving your money to one lender on one property and hoping they're going to pay you back, you're getting exposure to Courtenay, Campbell River, Victoria, Comox, Nanaimo, and anywhere probably in between. The second example I've given here is 3 Point Capital. They're really focused in Kelowna. That's where their headquarters at. Their return last year was 7%. They're, I think, at around 9 or so this year. These investments, typically you can put into your RSP. They're TFSA eligible. If you've got kids, you can put them into your RESP. And in 3 Points, in this instance, they pay their distributions out monthly. So you put 100 grand in, you're going to get 7 grand a year. They're going to take that, pay it per month or annually, whatever it is. So it is a passive investment, but the returns are significantly higher than putting this into a savings account, for example. The third example here is First Circle MIC. They're based on North Vancouver, a great group of people there. The return last year was just over 8%, 8.36%. They've got $120 million in mortgages lent, which is, it's a lot of money. And the interesting part is if you take a look at the risk profile, their loan to value. So obviously the total of the mortgages, and this would be first and second mortgages on their properties, is about 50%. So you've got a buffer there. If MICs are an interesting investment because when the economy's down, people need to borrow more expensive money. When the economy's up, people tend to not care about the cost of borrowing, so they go to the MIC. So the returns are correlated quite like significantly to the real estate market and the economy, but there is that downside protection because you've got people that come out of the woodwork that need to do a construction project or renovation or what have you, and they're happy to pay you know, 8 or 9% because it's such a short term. I'm sure everyone here has seen deals where if only I could get financing from the bank. You know, these are the type of people that the mix cater to as clients. So weaknesses can be, if everyone here seems to be in real estate, you're obviously putting your money in a real estate investment where, for example, like Owen's investment idea, where he's real estate heavy, but he's got a bit of his wealth in the stock market. There can be some diversification there, which can be helpful for you to kind of mitigate the ups and downs of the market. But I think we're all strong believers in real estate, and you have a professional firms that have been around for 20, 30, 40 years that have demonstrated an average return in, you know, under high single digits. Sometimes these guys are putting out 10, 12% returns in some years as well. So it really just depends on where you're investing. You have an exposure. So I do this for a living. I put my money into a couple different mix just in case there's, you know, some sort of weird, it could be fraud, it could be anything, or maybe they're just, you know, terrible money managers and they've ridden the market up. And when there's a downturn, you kind of see who's swimming without shorts when the tide goes out, so to speak. So there is that. That's a downside. They're not exactly liquid, so you can't go and sell these on your roll direct investing and get their money the next day. You're probably going to have a 30 to 60 day window to redeem your funds. So if you need the money for emergencies or what have you, then this is not an investment that you should partake in. And the other weakness, the last one is, it's boring. I mean, you know, you're writing a check and getting a statement once a year. It's not exactly exciting times, but it does allow you to participate in the real estate market without actually having the ownership, I guess, headache, for example, of tenants or renovating or flipping or whatever have you. So it is exposure without exposure.
Thank you, Chris, for bringing that forward. Yeah, you got a lot of requests about investing in mortgages. So I love the fact that you brought us 3 great options. You're welcome. Thank you again. Our next presenter is Colvin. Colvin began his real estate career with the Greater Victoria Property Group, working with investors across Canada to grow their real estate portfolios. With a background in engineering, he crunches numbers and finds opportunities for investors to increase cash flow and equity in a deal. He is known in the investment community both locally and nationally, representing Victoria as a place for investment opportunities. Being vice president of Royal LePage Commercial for Vancouver Island allows him to go deeper with clients into the multifamily development and investment arena. He is going to give my mouse a workout because he has so many slides. Are you there, sir?
Yes, I am. Can everybody hear me?
Yes.
All right. Thankfully, in a way, there were, I guess, some presenters weren't able to make it, but I'm still gonna do my best to go as fast as I can. I don't have a ton of time, but I want to make sure that no investor is left behind. So I'm gonna go over some of the basics, you know, like what you can do today to get ready for the right opportunity, how to spot an opportunity, and why Victoria is a great market, and what to do next. I also love quotes, and so that's where we're gonna start next. Nope. There we go. So the Seneca, the Roman Stoic philosopher, once said, luck is what happens when preparation meets opportunity. And I have taken it upon myself to suggest that luck is really what we would nowadays call success. Next slide. So I'm going to break that down into 3, right? So preparation plus opportunity equals success. And I think there's one thing missing that he wasn't accounting for, and that's that we're all, or a lot of us, are couch potatoes. So we need some action, right? If you're prepared for the opportunity shows up, but you're watching Dancing with the Stars, you're not going to get it. You need to go do something. It's probably not just going to fall in your lap. So next slide, one of the greatest examples of this right now, LeBron James. So the opportunity is that KD, Steph Curry, and Klay Thompson weren't playing all of last year. The preparation was tampering to get Anthony Davis, and the success was great. They won a championship. Next slide. I'm just kidding. I actually love LeBron James. And LeBron, if you ever see this, I'm sorry, please forgive me. I bought your sweater. It's all good. The real reason, the real steps of what happened here was he has an uncompromising physical and mental conditioning regime that he sticks to. And he and the Lakers made strategic moves for role players in Anthony Davis. And then when they went and they played through the bubble, then they got a championship and it was awesome. Yes, got my sports plug in. Okay, so preparation is defined as the action or process of making ready or being made ready for use or consideration, also known as the easy part, at least when it comes to real estate investing, in my opinion. Next, step one, talk to a mortgage broker or lender. Step two, get them everything they ask for in a timely manner. For example, paying your taxes and then being able to get them those documents. Next, define your goals and your why. And I want to emphasize not necessarily the strategy, because depending on your goals and your why and the market, that will dictate the strategy. You know, when you partner up with the right realtor and the right mortgage broker, and so, okay, now how do we get there given what the market's doing? Next slide. So preparation is check mark. It's done. On to the next. Opportunity is defined as a set of circumstances that makes it possible to do something, aka the research part. When most people think of research, they think of, next slide, that. And some people totally love that. I'm a power engineer by trade. The next slide is what I think most people think of when they think of research. Like, absolutely not. Burn the house down. I'm out of here. So I'm going to do my best to kind of help you along this journey with regards to Greater Victoria. So next slide. I'm going to break opportunity down into two parts. Right? Something is the buying real estate and making money, right? That's the goal. Set of circumstances I would define as the reason for demand. You know, if you're renting out a property, someone has to move into it and want to live there enough to pay you money. So there has to be a demand there. Next slide. Okay, so Victoria is the capital of beautiful British Columbia. It's often referred to as the California of Canada, and you can see why. I saw a photo of Southern Alberta dated November 9th this year, and like, it was horrific. You know, I complained that there's some leaves that have fallen in my yard, but they were trying to dig out of their house like the Maritimes. And so we're very blessed to live here, and it's honestly, it's driving a lot of people to come here, especially since COVID and they can't go to Arizona anymore. So this slide really tells the tale of what's happening since COVID, right? We're cannibalizing from other provinces. 36,175 people from January to June migrated to BC from within Canada. And that's only the stats that are available so far. So that's only Jan to June, not June to where we are right now. Special thank you to Alberta for donating so many people. So why is this happening? Well, lots of reasons. And again, I don't have a ton of time, so we're just going to jump right through them. Climate, we already went over that. Baby boomers, lots of them. We got jobs, low interest rate environment. We got working remotely trend, and we're at almost a 50% discount, which sounds ridiculous, but I'll make my point. Just stay with me. So set of circumstances, check. On to the buying real estate and making money. Okay, so Vancouver and Victoria, very close together, share very similar climate, but our real estate markets are very different. So as you can see here, based on the Vancouver Real Estate Board and the Victoria Real Estate Board, our benchmark price for single family homes are substantially different, actually about 50% different. I recently saw a listing in East Vancouver that sold for 2.2, and it was like 2,300 square feet, no interior photos, which is realtor knowledge for it's a piece of garbage. And then in Victoria, there's like a brand new luxury 4,000 square foot home for 1.7. So people can just win the lottery, sell there, sell high, buy low. At the same time, the rental market, something that we are interested in as real estate investors, Vancouver 2-bedroom rents in October were down 15% year over year. In Victoria, they were up 15% year over year. So you can get something at half off and the rents are going up, as opposed to something 100% more expensive, rents going down. Next, this is a thing. This is one of the some things. This just came on the market. It's a brand new build half duplex in a beautiful community called Souk. It's got ocean views. You can see in the upper right-hand corner a little bit. I wish they'd captured the view better, but that's mountains and ocean. 2,500 square feet, 5-bed, 4-bath, 4-bedroom upper, 1-bedroom down. The numbers, right? The part that we're really interested in here. So 685 plus GST, cash to close after all your closing costs is approximately $158,000. The 20-year running average for appreciation in Greater Victoria, 5.2%. So I'm totally comfortable leaving it at 5. The rent for this property, gross, should be about $3,550. Ones on the same street are getting over $4,000, but it's because the suite layout is better than this one. So I've brought this one down to $3,550, totally doable. Your cash flow after all expenses, including property management, should be about $833 a month. And all of those things together pump out approximately 29% ROI for year 1. Not bad. So next slide. We've ticked off the reason for demand. We've ticked off buying real estate and making money. So preparation and opportunity done. Success, but not quite, because who remembered that we also need action? So action is defined as the fact or process of doing something, typically to achieve an aim. And this is also known as the "it's up to you now" part, right? So I've put this together. The concept of this is take a screenshot, take a photo of it with your phone, whatever it is you need to do, because again, time constraints, I can't go over all of this in great detail with you. But save this for later and then reach out to me afterward and do the steps, whether it's this market or someone else's market, do the steps. So now, next slide, we've done preparation, we've done opportunity, you've taken action, hopefully, or you're going to, and after that, success is up to you. But if you do those 3 things, you stand a very good chance of putting yourself in a position for success. Now, investing, it's never guaranteed, but you're putting yourself in the right position. So thank you for having me on. I really, really appreciate it. If you're looking at the Victoria market, I'd love to be your go-to realtor. Thanks a lot, guys.
Thank you, Colvin. Love the passion. Really appreciate that. And the slides weren't that bad to manage.
All right, thanks.
One of our other presenters that's sad that they can't be here today, who's had a family emergency, but is very excited and looking forward to being a presenter in January, is Mr. Michael. Again, I will give you an overview of his background, and so you have an understanding of what we can look forward to in January when he presents. Michael's the president and founder of Prosperity Real Estate Investment, which has been established since 2002. His company has had significant success in investing in both commercial and residential real estate, where they currently hold and manage a portfolio of over 175 units worth over $30 million in several markets throughout Canada. Michael and Prosperity Real Estate investment expertise and success has been recognized by several associations like the Real Estate Investment Network, Canada Real Estate Investment Club, and the Canadian Real Estate Wealth magazine by winning several awards over the years that have been featured in books and magazines where he shares his wealth of knowledge. Follow him on Facebook as well. He has an amazing list and constantly pushing out great content on BRRRRs and flips and different things he's working on. He's a really great speaker. Michael is an avid public speaker, as he self-proclaims, and I attest to that, and an educator. He is also launching his new training company called Prosperity Real Estate Education, where he teaches and mentors others to be successful in the business called real estate investing. When Michael is not managing his real estate portfolio, he is focused on spending time with his wife and 2 kids, which is the main reason why he got into real estate investing after all, is to spend as much quality time as he can with his family. So we look forward to Michael, and we hope that the family affairs are taken care of today and everyone as well. Now, the last person speaking today is myself, and I'm a father, farmer, realtor, investor, coach, entrepreneur, and coach. I have 4 kids. I live in North Vancouver. I love real estate investing, and I have experience in joint ventures, foreclosures, pre-sale strategy, value add buy and rent strategy, a BRRRR strategy, which I'll talk about today. I've made that one up. A BRRRR strategy, of course, we've discussed 100% financing, and my favorite is buy and hold. My big passion in business and my mission is to help as many people as I can buy 1 to 3 investment properties in their lifetime. And the more they do early in their life, 5, 10 years later, I have never ever found a person that regrets buying an investment property. Rather, they wish they had taken my advice and doubled down more, leveraged more, and purchased more. Roland helps investors secure deals across Canada, and I'm working hard to become known as the Canada-wide investment real estate guy. So what I want to talk to you about today is a strategy that I've created or termed. I'm sure lots of people have done this, but what it's called is buy, rent, hold, and a developer sale. So the BRRRR strategy, what is it? It's to find a property that is dramatically underutilized with great future upzoning use. So you want to find a property at a manageable price with positive or neutral cash flow, unless in certain situations you can sustainably manage the transaction with a slight negative cash flow in order to potentially gain generous returns in the future. Of course, positive cash flow outweighs the negative, but certain opportunities come in many forms, and in certain markets such as Vancouver, there might be an opportunity to see a slight negative cash flow if the opportunity is big enough. The goal in this strategy is that in 3 to 10 years post-purchase, you're going to sell the property to a developer. The process, lots of research is required. You want to do your due diligence long before you purchase the property and make sure that you do have the right call. You want to look into city zoning, future trends, and all the information you can get. You want to choose an opportunity with the lowest chance of not being sold. And you want to see proof beyond hearsay. So, you know, I do business in a lot of stratas where the myth is that there's this mystical buyer that's going, you know, that's been talking to the strata about buying the whole building, and then later you realize that's certainly not the case, and there's no real process or progress that has been made. The transaction process in such a strategy is quite regular. You purchase the transaction as normal, you secure the transaction and you rent it out, and then you wait for a developer to buy you out. And there's lots of things you can do as long as you've purchased the right property to massage that exit. You would then reinvest your gains into other opportunities and rinse and repeat. So again, the opportunity is in an ideal environment, you can buy the right property with this potential that also has cash flow. However, sometimes that's not the case, and you can still achieve an amazing windfall of a return if the transaction is realized. You will sell at a far above market price, and you'll have cash flow along the path. You'll pay down your principal, and of course, that rental income. The risk, you are purchasing a property for beyond what it's currently used for. It has potential, but you are buying something that the best and final use is still to come. You potentially are paying a premium for that property that is currently zoned or has the potential for that zone or is very close to a densification for future development, but again, it's not guaranteed. What happens if you buy a property and the zoning changes? What happens if you buy a property in a building where it feels like the neighbors are completely on board to sell, but then in the end, they don't want to sell and you don't get the numbers to realize that outcome? You have what if you have low liquidity and you want to get out before the goal is realized? So an example of this strategy that we've recently accomplished with a client was in Kerrisdale. There's a building out there, that small building, 30-unit building. If you look at that slide, you can kind of see to the right of it, there's now a tower, not a tower, but a higher building that I think is 2 stories higher. Ironically enough, when that building was built, they were paying air rights over this one, and I think they paid the strata around $300,000 just to move the crane over the building while they were building. So in this case, there was clear, clear visibility of turnover and of zoning actually happening and people building between these 2 buildings. So it wasn't just the projection of what could happen. And in this case, in 2017, the strata received an unsolicited offer for the entire building for $24 million. It's not a 33-unit building, it's a 30. Yeah, double check. Let's say it was 33. That would have given it a valuation of about $727,000 had it sold. The strata was not interested or even aware of the option of selling, but it started a conversation. It had a lot of older owners in there, and they started the conversation of what if we sold? And is 24 million best use and best value of the land? So that triggered them to do the due diligence and have a commercial real estate firm that specializes in wind-ups provide assessments for the building, which is 3 stories, but again can be zoned for higher. The strata received an estimate from 2 of these companies in 2018, where they valued the property at $30 million. And again, that would put an average value, not all units are the same, but an average value of over $900,000 to this unit. And again, this was documented paperwork. It wasn't just, you know, conversation of strata members saying what was happening or what potentially could happen. The building was never listed for sale because the market softened in 2018. And so the owners wanted to wait until construction of the Skyline or SkyTrain station at Broadway and Alma came to fruition. And since then, the folks in there have really started talking about being open to a sale when the time comes. So there's a real potential for a windfall with this building. We privately purchased a 1-bedroom top floor in the building for $535,000. We rented out for $19.90, kind of at the worst time of COVID. The rent should be closer to about $22, $23. The tenant pays utilities. It is currently cash flow negative at $190. But again, if we hold this long enough and we raise the rents, we will eventually eliminate that cash flow negative. And if the tenant leaves in 2 years, we'll definitely recoup that because we'll be able to re-rent at a higher price. But even with some small negative cash flow, it has principal pay down every month of $600. So, you know, if you took the equity, which this buyer did, he took the equity from another property and put it down as the down payment. And so it was 100% financed as well. And every single month by doing that and moving forward with this risk and this opportunity, they are $600 further ahead approximately with principal pay down. The goal is to sell the property in the next 3 to 10 years when the developer comes calling. And again, it is a unique situation where the building right beside it shows some real potential that when that development is finished, that they will be approaching the strata. So that is the BRRRR strategy. Folks, it's been a pleasure, and we actually finished on time. I welcome all of you to send any questions that you have, and I will connect all of you with the recording, and please connect with the presenters. And again, any feedback is welcome, and we'll do this again in January. Thank you, everyone.
Awesome presentation. Thank you.
Thanks, Roland.
Thank you, Roland.
Good night, guys.
Thank you.
Thank you, Adele.
Great, thank you.
Thanks, Roland.
Thanks a lot, Roland. See you next time.
See you next time.
Thank you.
Thank you.
Thanks, Roland.
Cheers.